The AI world is shifting rapidly now. Every headline reveals another shocking breakthrough. But behind the excitement lies hidden instability. Massive companies push boundaries without considering consequences. Today's story exposes a dangerously fragile ecosystem. This system powers nearly every modern AI. Yet, its foundation shakes under growing pressure, and few people truly understand the risk. We begin with soaring demand for compute. AI models grow bigger with every generation. Training these models requires unimaginable processing power. One company dominates this explosive new market. NVIDIA sells GPUs at unmatched global scale. Their profits surged during the recent boom. Their valuation climbed beyond $4 trillion. They became the most valuable company worldwide. But this massive success hides troubling weaknesses. As NVIDIA expanded, the cloud giants followed. Microsoft, Amazon, Google, and Oracle accelerated investments aggressively. Their data centers exploded in size quickly. Billions poured into infrastructure to satisfy demand. AI workloads overwhelmed every server they deployed. Hyperscalers rushed to build at record speed. Yet even they couldn't keep up anymore. This shortage created new opportunities for outsiders. A new wave of companies suddenly emerged. Investors started calling them the neoclouds recently. These firms built purely AI-focused infrastructure exclusively. They purchased GPUs and rented computing capacity. They grew faster than any previous cloud firms. And one name rose above all others. That name was CoreWeave, the industry's upstart. CoreWeave began its journey unexpectedly early on. It originally mined Ethereum using NVIDIA GPUs, but crypto markets crashed, destroying mining profitability instantly. CoreWeave pivoted and started renting GPU power. For years, demand remained relatively small overall. Then ChatGPT launched and changed everything dramatically. Suddenly, AI compute became the world's gold. Every company desperately needed high-performance GPUs, and CoreWeave sat ready with rising capacity. But here's where things grew complicated quickly. OpenAI became the single largest GPU consumer. Their models consumed unimaginable computing resources daily. Microsoft had invested billions into OpenAI earlier. But Microsoft lacked enough GPUs for promises made. So Microsoft turned directly to CoreWeave abruptly. They used CoreWeave as a subcontractor immediately. CoreWeave supplied power, and Microsoft resold it. OpenAI consumed that compute to train models. This arrangement created tangled financial dependencies. CoreWeave needed massive expansion to meet demand. They built data centers at breakneck speeds. Those centers required energy, land, and infrastructure. Most importantly, they required millions of costly GPUs. Every expansion required billions in upfront capital. CoreWeave borrowed heavily from lenders worldwide. Debt accumulated faster than operational profits grew. Their revenue numbers looked impressive on paper. But profitability told a very different story. Operating margins shrank toward barely sustainable levels. Depreciation of GPUs wiped out earnings completely. Rapid model upgrades made hardware obsolete rapidly. Replacement cycles accelerated far beyond expectations. Expenses climbed faster than revenue could grow. Meanwhile, data center construction never paused once. CoreWeave continued borrowing heavily to expand capacity. They planned multi-year contracts with major clients. Their backlog reached tens of billions quickly. But every contract required more new infrastructure. Each expansion demanded even more borrowed money. Behind the scenes, another issue emerged quietly. Their reliance on a few customers intensified dangerously. Microsoft represented a massive portion of revenue. NVIDIA became both supplier and major client. And OpenAI's hunger drove everything forward explosively. If any major customer stumbled, disaster loomed. The AI industry celebrated rapid growth publicly. But under the surface, pressure kept building. Debt piled higher with every new contract. Demand outpaced realistic financial sustainability massively. And CoreWeave stood directly at the center.
CoreWeave's situation grew more complicated recently. The company expanded faster than revenue justified. Their facilities required non-stop maintenance and energy. Technicians operated constantly to manage infrastructure loads. Electricity consumption soared with each deployed cluster. Cooling systems strained under relentless computational pressure. Operational costs ballooned far beyond earlier forecasts. Even worse, GPU depreciation accelerated unexpectedly. NVIDIA released new architectures every 2 years. Each generation outperformed the last dramatically. CoreWeave's older GPUs lost value quickly. Depreciation drained profits from every quarter. Their financial statements showed concerning downward trends. Operating gains shrank while overall losses climbed. The company relied heavily on aggressive financing. Debt ballooned into multi-billion-dollar commitments rapidly. Interest payments consumed revenue at alarming speed. Their margins hovered dangerously close to zero. Yet expansion continued because demand exploded. AI companies begged for more computing capacity, but meeting demand required constant large borrowing.
This created a dangerous financial feedback loop. Borrowing funded expansion, but increased liabilities. Higher liabilities demanded more revenue growth. That growth required building even more facilities. Each new facility required additional debt financing. The cycle repeated endlessly without slowing down. Their backlog reached astonishing levels recently. Contracts stretched across multiple years ambitiously. Some agreements extended beyond 4 full years. These commitments obligated CoreWeave to massive construction. Future costs approached staggering multi-billion-dollar thresholds. Expanding capacity required huge GPU purchases continuously. Filling each data center demanded extensive capital outlay. Estimates predicted nearly $80 billion in hardware. Yet CoreWeave lacked the resources up front. They needed lenders willing to accept risk. But lenders feared heavy customer concentration issues. One customer represented the majority of demand. That customer was OpenAI, the industry giant. OpenAI consumed unprecedented quantities of compute capacity. Their appetite grew beyond all previous projections. But OpenAI's financial condition raised concerns. Their revenue failed to match growing expenses. Their losses increased dramatically each passing quarter. Billions evaporated as models expanded rapidly. Their development pace required enormous compute commitments. Contracts accumulated faster than income could support. OpenAI relied heavily on partners for resources. Microsoft supplied credits instead of direct funding. These credits created complex financial structures. OpenAI used credits to pay Microsoft. Microsoft purchased compute from CoreWeave, then resold. This arrangement masked deeper financial fragility underneath. If OpenAI faltered, Microsoft faced exposure. If Microsoft weakened, CoreWeave faced disaster. The entire chain leaned on uncertain stability. Then Google entered this tangled ecosystem. OpenAI approached Google for additional compute. Google lacked GPU capacity to fulfill orders. They refused to build costly new facilities. Margins were too low for long-term returns, so Google adopted the same subcontracting model. They outsourced workloads directly to CoreWeave instead. Google became another middleman, earning risk premiums.
This complicated relationships throughout the entire industry. OpenAI didn't contract directly with CoreWeave exclusively. They spread risk across multiple giant partners. This provided flexibility but hid deeper dangers. CoreWeave relied on these companies to buffer risk, but those buffers depended on OpenAI's success. If OpenAI struggled, shockwaves hit everyone. In this chaotic landscape, NVIDIA intervened strategically. They offered CoreWeave a strange financial guarantee. If demand collapsed, NVIDIA promised huge purchases. They agreed to buy billions in compute. This backstop helped lenders feel more comfortable. It allowed CoreWeave to borrow even more. NVIDIA essentially propped up their own customer. The arrangement created bizarre economic incentives. NVIDIA sold GPUs to CoreWeave initially. Then NVIDIA promised to rent them back. This circular structure distorted financial transparency significantly. It inflated perceived demand for computing resources.
It encouraged even more aggressive expansion decisions, and it deepened the industry's overall risk exposure. The AI supply chain tangled further tightly. Each player relied on others for stability. Money flowed through middlemen, not end users. Contracts inflated capacity far beyond realistic needs. Everyone assumed future revenue would skyrocket reliably, but assumptions rarely survive turbulent global markets, especially when demand depends on volatile innovation cycles. Underneath the impressive growth narrative, fear developed. Executives realized dependence on a single endpoint. Nearly all roads led back to OpenAI, and OpenAI burned astonishing amounts of capital. Their spending patterns created unprecedented systemic vulnerability. If they stumbled, collapse could cascade instantly. The deeper analysts looked, the worse became. Financial structures across the ecosystem appeared unstable. Huge corporations masked vulnerabilities behind optimistic forecasts. The AI boom created unrealistic long-term expectations. Every company believed growth would continue endlessly. But debt obligations painted a different story. CoreWeave faced enormous off-balance sheet commitments quietly. Many data centers were not fully owned. Instead, they leased facilities from other firms. These firms included former Bitcoin mining companies. Miners once operated massive power-hungry facilities continuously. Their infrastructure matched AI computing needs perfectly. So miners pivoted and leased buildings aggressively. One miner, Applied Digital, secured a huge contract. CoreWeave agreed to lease their center long-term. The agreement stretched across 15 difficult years. Payments exceeded $7 billion over the contract's duration. This translated into nearly $500 million annually. Costs per gigawatt were shockingly high overall. Scaling this pricing revealed staggering financial burdens. Future rent obligations could reach $6 billion yearly. These commitments added immense pressure on CoreWeave. Debt already exceeded $14 billion recently. Interest expenses consumed enormous portions of revenue. Major repayments approached quickly as deadlines neared. Lenders grew nervous about concentrated customer exposure. Yet, expansion remained the only survival strategy. Their huge backlog seemed promising at first. 50+ billion in orders sounded reassuring, but every order required upfront investment immediately. They needed GPUs, facilities, utilities, and technicians. Cash outflows occurred far earlier than inflows. This inverted structure amplified their financial danger. Revenue promised, but expenses demanded instant funding. Meanwhile, contract details revealed deeper dependency. Microsoft accounted for massive early backlog portions. Microsoft purchased compute primarily for OpenAI consumption. So Microsoft didn't represent independent, diversified demand. They simply funneled OpenAI's needs through cloud credits. This meant CoreWeave depended on OpenAI indirectly also. New deals confirmed this uncomfortable reality repeatedly. OpenAI signed enormous multi-billion-dollar agreements directly. These contracts stretched across several upcoming years. They expanded commitments multiple times without delivery. The scale reached unprecedented 20-plus billion totals. Yet OpenAI still hadn't received any compute. Construction delays pushed deployment farther into future. Worse still, OpenAI's financial health deteriorated. Losses exploded quarter after quarter recently. Operational costs far exceeded generated revenue. Scaling models demanded more compute continuously. Spending increased faster than income could grow. Dependence on external funding intensified extremely fast. OpenAI's commitments created systemic risk across industry. Their obligations exceeded a staggering trillion total. This amount shocked analysts reviewing leaked data. No AI company ever carried commitments comparable. If OpenAI miscalculated future revenue potential drastically, then cascading failures could strike entire ecosystem instantly. CoreWeave knew concentration risk was dangerous. They attempted publicly to minimize perceived exposure. Executives claimed backlog diversified significantly this year. They insisted reliance on single customers was decreasing. But careful analysis told a different story. Majority of backlog still connected to OpenAI demand. Some indirectly through Microsoft and Google contracts. Others directly through long-term multi-billion agreements. If OpenAI faltered, consequences would be catastrophic. Microsoft would lose billions in credit obligations. Google would face risks from resold compute contracts. NVIDIA would be stuck with unwanted compute capacity. CoreWeave would face overwhelming debt without revenue. Investors would absorb immense losses almost immediately. Financial interdependence created a fragile chain. Every participant relied on others for survival. Each company assumed the others remained stable. But no one addressed structural risk realistically. Optimism overshadowed critical financial evaluations repeatedly. NVIDIA's backstop deal further distorted the picture. The company guaranteed billions in compute purchases. This guarantee allowed CoreWeave to borrow more. Borrowed money funneled back into NVIDIA hardware. NVIDIA supported its own sales through circular commitments. This dynamic inflated GPU demand artificially over time. The situation resembled classic systemic risk patterns. Industries where everyone assumed endless future growth. Where companies financed expansion through constant borrowing. Where demand projections ignored possible downturn scenarios. AI's explosive growth overshadowed fundamental financial logic. No one wanted to admit growing instability publicly. But cracks continued forming beneath accelerated expansion. Analysts warned about unsustainable commitments rising. Debt reached levels impossible to service reliably. Operational margins remained razor-thin despite huge revenue. And customer concentration threatened total collapse risk. The entire ecosystem started resembling a financial powder keg. As pressure intensified, tensions grew across companies. Executives privately acknowledged unsustainable financial exposure. Yet public statements painted confidence and stability. Everyone insisted the AI boom remained unstoppable. But internal documents told a different story. Balance sheets showed rising liabilities everywhere. Key players depended on fragile interconnected agreements. The industry operated on borrowed time collectively. CoreWeave's leadership faced mounting operational challenges daily. Their data centers fell behind construction schedules. Energy demands surged faster than grid partners expected. GPU supply chains struggled under enormous global pressure. Technicians raced to maintain failing cooling systems. Power density pushed facilities to dangerous thresholds. Failures risked downtime for major paying clients. And downtime threatened confidence across the ecosystem. Despite internal chaos, expansion continued aggressively. Contract deadlines forced non-stop scaling at speed. More GPUs arrived requiring immediate deployment everywhere. Teams rushed installations while juggling older hardware. Obsolete units piled up with limited resale options. Depreciation continued hammering CoreWeave's financial performance. Losses widened before new revenue could materialize. Even worse, lenders tightened requirements suddenly. They demanded stronger guarantees for future financing. They feared CoreWeave's customer concentration drastically. They feared OpenAI's worsening quarterly results. They feared rapid depreciation undermining expected returns. Every new warning sign increased their hesitation. Yet CoreWeave needed non-stop capital to survive. In response, NVIDIA strengthened support even further. They enhanced their commitment to buy compute. This move reassured some nervous lenders temporarily, but it intensified long-term systemic vulnerabilities sharply. NVIDIA effectively guaranteed CoreWeave's future expansion path. This locked both companies into mutual dependencies. Each relied on the other's stability heavily. If one collapsed, both faced massive fallout. Meanwhile, Google's involvement deepened risk exposure. They leveraged their strong credit to profit. By reselling compute, they monetized financial safety. But this model assumed constant OpenAI payments. If OpenAI struggled, Google absorbed major obligations. This added another weak point to system stability. Microsoft also remained deeply tied to OpenAI. Their cloud credits masked real financial strain. Those credits obligated Microsoft to provide compute, even when internal GPU supply fell short dramatically. So Microsoft leaned even more on CoreWeave, which further increased concentration and systemic dependence. Many analysts warned collapse was becoming possible. They noted unsustainable leverage across core players. They highlighted exposure to a single endpoint. They warned cascading failures could erupt quickly. If OpenAI failed commitments, shockwaves would follow. CoreWeave would lose massive annual revenue immediately. Microsoft and Google would inherit sudden liabilities. NVIDIA would sit on unused computing capacity. Entire AI infrastructure could face severe contraction. The industry's long-term stability depended on uncertain assumptions. Everyone bet on AI revenue skyrocketing soon. They believed future models would conquer markets globally. They expected enterprise adoption to rise endlessly. They predicted multi-trillion-dollar opportunities becoming reality. But few questioned whether timelines were realistic, or whether customers could sustain required spending. If these projections failed, consequences would be enormous. Billions invested into infrastructure would evaporate quickly. Debt-financed expansions would become catastrophic burdens. Companies would scramble to restructure impossible agreements. Credit markets would reevaluate risk instantly across AI. Future development would slow dramatically due to losses. The truth is unsettling but necessary now. The AI boom created incredible innovation worldwide. But rapid growth brought hidden financial danger. CoreWeave became the fragile center of everything.
Microsoft, Google, and NVIDIA depended on it. And OpenAI drove unprecedented demand unsustainably fast. One misstep could trigger cascading failures quickly. The industry must acknowledge risk before disaster. Strong oversight is required to protect stability. Companies must restructure commitments and reduce concentration. They must diversify clients to avoid collapse. They must reduce circular financial engineering immediately. Transparency must improve across every major participant. Only then can the AI ecosystem stabilize. Only then can long-term growth become sustainable. Without caution, the future remains dangerously uncertain. The coming years will decide everything collectively. Whether AI continues rising or faces contraction, whether companies adapt or collapse under pressure, whether innovation thrives or debt destroys progress, the outcome depends on decisions made today.